This lesson is about recognizing zone formation types. And this is important because learning how to spot these zones will give you a great idea of which areas you should really focus on for your trade locations. You need to practice this whole concept to be able to make a distinction between the types of formations, but I'm never going to quiz you on zone types. However, the end goal is to have this skill become second nature, being able to locate and name the zone formations quickly. All right, let's get into it right away. There are three types of supply and demand formations, but really there's three for supplies and three for demands. So here are the supply types: rally-based drop, drop-based drop, and normal formation. And then we have the opposite for demand types, which is drop-based rally, rally-based rally, and normal formation. Don't worry, I'll go through each of these one at a time. So back to those supply types. The first one I mentioned, rally-based drop formation. So here it is. This is what it looks like. So with this formation, the price tends to keep going up, and then at some point it consolidates, making this base, making like a little rectangle, and then it proceeds to reverse direction, creating the drop, hence rally base drop. And it can be said that rally-based drop looks to me quite a lot like the Devil's Tower from Close Encounters of the Third Kind. See, I always thought that rally-based drop, rally-based rally, it's like quite a bit of a mouthful. So when I was learning about it, I was always reminding myself of different objects and things that these formations remind me of. You can refer to rally-based drop as rally-based drop, or RBD, or Devil's Tower. Whichever one will help you visualize the formation better, use that. The second type of supply is what the supply-demand community calls a drop-based drop. Again, a bit of a mouthful. Some people shorten it to DBD. If I compare this drop-based drop to the rally-based drop, you will see that rally-based drop really looks at how the price arrived at that base area. Whereas with the drop-based drop, they're not really interested in how the price arrived, but instead how the price left the area. So how did it do that? Well, it made one drop, then it consolidated, and then made another drop. Every time I was looking at these formations, to me, they looked a lot like staircase formations. So if you imagine this is price movement, you have a drop, then you have a base, and then another drop. With the drop-based drop formations, some people will argue that you can trade the base as a potential area of interest rather than using the originating area. Bit of a slippery slope, because if you're on anything lower than the daily chart, especially on low time frames, using something that isn't an originating area, it's again a bit tricky, and I wouldn't really advise it. So for me, if I'm on a 4-hour chart, 1-hour chart, 30 minutes, 15 minutes, I will always refer to the originating initial area where the drop came from. But if you do find these drop-based drop formations on the daily chart, in special cases, if a Q point happens to line up with the base area, then you can use it for trading as well. Because usually the drop, when it happens, it sort of takes the whole price away from the initial Q point. So you can use it for trading, but use some caution, or at least confirmation entries if you're going to use the base. Anything smaller than a daily time frame, just go for the originating area. And finally, the third type of the supply, I call these the normal formations, because they're usually comprised of only 2 candles, and there's no real base to speak of. However, just by the fact that you have this like for example, this first one is the engulfing pattern, the second one is a more of an inside bar and then turned into 3 inside down. which is a variation of an inside bar. When I'm talking about these formations, I'm obviously expecting you guys to spot these areas on larger time frames. So 4 hour, daily, weekly, monthly. So if you see all of these formations on low time frames, they will not have the same accuracy and same probability of working out as the formations that you see on the daily chart. When you see these on lower time frames, they're usually not strong enough to assume that a trade will work out from a limit order. Doesn't matter how high they score, but just by the fact that the formation is on a low time frame, it weakens the probability of the zone. Normal formations have an even lower probability of working out on low time frames because they're only comprised of 2 candles. If they are on a daily chart, then obviously 2 candles is quite a lot of trading information, but not on anything lower than 1 hour, okay? Including the 1 hour. Now, if you look at this formation that was made through an inside bar, which then turned into 3 inside down pattern by creating this big black candle. If you go down to investigate what actually happened in this black little candle that created the inside bar, very likely you will find a base in there. So although this might be a normal formation on a large time frame, when you drop down, you will get some kind of a base and a different formation. It might be a rally base drop, for example. Furthermore, when you're looking at these areas, these levels really need to be inside the swing extreme, inside a top or bottom Q point. This rule is incredibly important for swing trading, mainly because if you pick zones that are outside of the Q points, you cannot really expect the trade to survive longer than about a session or 2. In order for a swing trade to really survive more than 1 session, 2 sessions, or even 1 day, the value of its location has to be really high, which means it has to be at an extreme of a swing so that you have any chance of a mean reversion trade. If you're trading away from the swing extreme, you could be correct on the overall direction that eventually takes over, but you'll have a terrible location that will mean that your trade will not survive for very long. It's entirely possible to be correct on the trade direction, but to have a really terrible trade location, which is why you keep losing trades. As I said, these are 2 candle formations. Let's focus on this left one. It's a 2 candle normal formation comprised of a bearish engulfing candle. Anytime you see an engulfing pattern in general, the pullback to the conterminous line of this newly formed supply is an excellent area for a trade entry. Sometimes people freak out if they miss the move, but actually I love trading from pullbacks to the conterminous lines from engulfing patterns. It's one of my main ways to enter a trade. So instead of chasing the move, you will notice that quite a lot of the time the price pulls back to the conterminous line and then starts to move away in the other direction. So what I like to do, if I'm going to use any kind of a limit order, is to actually place the limit order on the conterminous line of the engulfing. So these were your supply formations, and now we have the exact equivalents for the demands. To remind you, here they are. So we have drop base rally, rally base rally, and normal formation. Starting with drop base rally, this is what it looks like. So the price drops, creates a base, and then rallies the other way, hence the name. I like to call these the U-shape. Sometimes I refer to them as bucket shape because it sort of looks like a bucket, but any of these names will do. So you can either call it drop base rally or DBR or U-shape or bucket formation, however it's easier for you to memorize. So this one is the exact opposite to the rally base drop from the supply. So now it's the other way around. So you have a drop base rally. And here's another example of a U-shaped formation or a DBR where the price drops, creates a little base in the form of this morning star, and then rallies the other way. And as you start to learn more and more about price action patterns, about supply and demand, you will see that they're all very much intertwined. They're all methodologies that complement each other. Now, just like we had the drop base drop for supplies, we also have the opposite version for the demand, which is called a rally base rally. I also called this staircase, so you can refer to it however you like. The whole point of this formation is that the price rallies, creates a base, and then rallies again. Just like the supply version, if these are located on the daily chart and above, the base areas are possibly valid for trading, but only if they overlap a Q point. However, on very low time frames, the base trading is absolutely a no. You will be looking at the originating area of the entire formation. Next, normal demand formations. Just like for the supplies, these are two candle demands, usually comprised either from an engulfing candle or an inside bar. I also use engulfing patterns of this sort for intraday trading too, when they are located at a larger time frame supply and demand area. But to trade like that, you need a number of things to line up, and obviously it implies knowledge of the normal trading day. It also helps if you know how to read market profile. And here's another one, choppier version, but if you can see, here is that test of the conterminous line of the demand, which brings another move in that new opposing direction. To wrap up this lesson, I'm going to give you some homework. So your homework is going to be to open up your charting platform, whichever one you're using, and to find as many of these formations as you can. I didn't create a specific exercise for this for you to download, because I believe that by now you should already start using your own charts to locate these areas yourself without me drip feeding you some relatively easy examples that are kind of textbook. But I will open some charts now just to show you how skilled you really need to become in finding these formations. It really needs to become second nature to you. Okay, so here's a chart of GBP yen. It's a daily chart. So right here I can see the normal formation, and here's that test of the conterminous line and a nice move in the other direction. Then we have a drop base rally, then we have a drop base drop, and then another drop base rally. Then here's another rally base drop, and another rally base drop. Let's go to the weekly chart just to see what's going on there. Lots of normal supplies, if you can see, but this looks like it might be a rally base, might be a drop. So this is where speculative skills of these formations can come in handy. So here I don't have a finished drop yet, but because I know what the formations look like, it's likely that the drop is going to follow after this base. So you have a rally, base, and a possible drop, right? So that gives me a direction for my trading plan for the next week or so, maybe a couple of weeks. On the large time frames, you will get a number of those normal formations. So here's a normal formation here, here's another one there, and another one here, and another one here. This is an inside bar, bearish engulfing, and again, look, a test of a conterminous line. So in case you don't see that, I'm going to mark it. You see that? Test of a normal formation supply and almost an immediate reaction from it. Okay, let me get another chart now. Let's switch to the daily time frame. Here's a nice, very obvious rally base drop, and then again rally base drop. Then you have a drop base drop. This is a drop base rally now. Drop base rally. Let's switch to the monthly chart, because you will see my point about two candle formations, the normal formations. So here's one, it's a bearish engulfing supply. Here's another one, demand, normal formation, again inside bar, and another normal formation. So as you can see, on large time frames, you get a lot more of those two candle normal formations, which is why I decided to include them. And let's get another instrument that is not a forex pair, and this is a gold chart. So this is an entirely different asset class. So it's not forex, it's gold, it's commodities. So let's see how different these are. So obviously candles a little bit choppier because gold is a little bit crazy. because it's quite volatile. But you can still see drop, base, rally. Then you also have this normal formation that causes another reversal. Then before that, it was preceded by another drop, base, rally. Here you have a drop, base, drop. Okay, so it's all the same thing. Like, the point of me showing you the commodities chart is the fact that all of these formations will happen in a vast majority of different asset classes. It's not just Forex. And for that, let's have a look at crude oil as well. Why not? Now, crude oil tends to go on these interesting trends, as you can see, and in a way it's kind of easy to trade it sometimes because you only need to be like one-sided. In fact, some of the money that I made as a prop trader was made during the massive bear run that happened in crude oil, and it was just a case of wake up, wait for NYMEX to open, an hour after the market makers have settled down, execute a sell. And that was pretty much it. So as you can see, I'm going through all of these formations without thinking. So I'm not going, ooh, which one is this? Is it rally, or is it the other one, or is it drop, base, drop? So I'm not doing that because in my head, I can tell you in the split of a second what the formation is. You need to get to that level of skill, which will help you to locate the areas that are tradable.